Hello, everybody, and welcome to our seminar. We appreciate everybody showing up. Hopefully there's a lot for you to learn today. Feel free to ask questions anytime. We'll have somebody here taking questions online. Just for the record, we are on a 10-second delay, so there may be a little bit of a delay to answering some of the questions. My name is Larry Jackson. I'm the Vice President of Real Estate here at the Credit Union. I've been here for 4 years, but been in the industry for about 27 years. So hopefully you'll learn a lot here today. I'm used to these interactions where we're live with people, so if you have questions, please ask. That's what we're used to. So anything we can do for you here. Whether you're looking right away or you're months away from looking for a new home, this seminar is designed to be able to help you in whatever stage you're in. So we hope to be able to give you some insights and some knowledge that you may require to be able to do this. So the number one thing that affects the ability for you to get a home loan is the credit. So what we want to do is talk a little bit about credit scores and credit today. So as you can see on the screen, there's a nice little infographic about how credit is affected. You can see the number one item that affects your credit is your payment history.
Yep, okay.
So payment history is 35% of your credit score. That means that more than 1/3 of your credit score depends upon how well you pay your credit. As you can also see through the presentation, the other part that affects your credit score greatly is how much you owe on debt. Now, what that really means is how much available credit you have on revolving lines. So let's just say that if you have revolving lines in the amount of $10,000 available, you don't want to have any more than about $5,000 used on that $10,000. So you want to stay under 50% to be able to keep the credit score a little bit higher. You can also see items like new credit, length of credit, and type of credit. The credit mix is also part of your credit score. The credit mix in and of itself, thinking about, you don't want to have just a credit file full of nothing but revolving debt, credit cards. You want to have other things, car payments. Obviously, a home would be something else that would be on your credit. Length of history, that's going to have about 15%. The longer you have credit, the more history the credit bureau has, the more data they have to say you're going to pay your bills on time. And then new credit really talks about not just how many lines you have opened or how many new credit availabilities you have, but also the amount of inquiries that you have. So making sure that you don't go through and apply at a lot of different places for a lot of different things in a short period of time. Use the inquiries very sparingly. Do your research ahead of time. Apply where you think you want to be before you start applying around everywhere, because it will affect your credit. Also, know this, that credit scores move down very slowly. Or they move down very quickly. They move up very slowly. So if you miss a payment, it will have a great effect on your credit score. And then it will take probably 6 to 12 months to make up for that missed payment. So make sure that you watch what you're doing on payment history. Don't go more than 30 days past due. Also know this, if you're a couple of days past due, that does not get reported on credit. You have to be at least 30 days past due in order to be reported late on your credit. Also know this, if you're checking your credit through places like Credit Karma or other places like that, know that the credit score that you see from those institutions is different than the credit score you may see when you have your credit pulled for a mortgage application. The reason for that is there's different variations of credit scoring, and the mortgage credit is going to put more weight on different items than you may see on your consumer side. So if you get a consumer credit bureau from somebody like a Credit Karma or somebody like that, just know that that credit's going to be a little different. Also, understand that we pull credit from multiple different institutions. So the three major credit bureaus, Equifax, Experian, and TransUnion, we pull all three credit scores. We use the middle credit score as your qualifying credit score. What that means is if you have a credit score of 700, 710, and 720, the 710 is what we're going to use. And do realize that each of the credit bureaus could have a different score, even if all the credit is the exact same across the board. So just understand that there could be different scores from different places. One of the common mistakes when dealing with credit is closing out zero balance credit cards. A lot of people pay them off and think closing them out is the best thing to do. And that's the exact opposite of what you should do. What you should do is if you pay off a credit card, you want to leave that credit card open. You heard me say earlier that 30% of your credit score is how much credit you've used versus how much is available to you. If you close out zero balance credit scores, you're taking away the denominator of how much is available to you. So don't fall into that trap. Make sure that if you pay off a credit card, you leave it open. That way your credit score stays up. Also, you heard me talk about inquiries earlier and new credit. Understand that the credit bureaus do believe that it's okay to shop. So if you have credit inquiries from the same types of institutions within a 7-day span of time, the credit bureau will only count that as one inquiry overall. So when it's looking at your credit score, if you applied to 3 different places while getting an auto loan and they were all for an auto loan and they were within 7 days, it acts as just one credit inquiry. So again, make sure that you know what you're looking at on credit. Make sure you understand how the credit is affected, because this will be the difference between a good rate on a home loan and the difference between maybe getting something that's not as great as you could have. That can cost you a lot of money in the long run. If you think about most mortgages are 30 years, and if you're costing yourself $20 to $30 a month because your credit score wasn't as great, you're looking at $360 a month for 30 years. That's $9,000. That's a big number when you start thinking about it. So make sure your credit is taken care of. That's going to be the first thing that everybody's going to take a quick look at. Moving on, what we want to do is talk about what that home purchase process looks like. I know some of you have heard how difficult the process is. You've seen horror stories of people who have taken forever and there's all this documentation. And frankly, I'm going to be honest with you, most of those are probably true. This is a long process. It's not an easy thing to do, but it's worth it in the long run. You're creating wealth for yourself, for your family, and you're also doing good things for your community. You're putting more money into your community. You're putting jobs into your community. Homeownership has a lot of values. So it's worth the effort to go through this. To get started, I think the first thing that you really want to take a look at is preparing your financing, getting ready to actually get pre-approved for a loan. First thing you want to do is check your credit. You saw earlier as I was looking at this previous slide, this website down here that's annualcreditreport.com. If you're not checking your credit on a regular basis through a Credit Karma or somebody like that, you still have the ability to get a free credit bureau once a year from all the credit bureaus through the annualcreditreport.com. That's a federal rule, federal law. So if you're not using one of those institutions, use the annualcreditreport.com to check your credit and make sure you know where you're at. But then shop around and look around for the best kind of loan for you. Look for, local institutions typically have very good rates. They also have different loan programs that may be able to be helpful to you in your situation. They also understand your community a lot better than somebody who may be in Detroit or Des Moines, Iowa, or other places. We're here in St. Louis. We know our St. Louis market. We also know the markets of where all of our branches are at. So we have some dedicated knowledge to those areas. Look for somebody with that dedicated knowledge, somebody who can really help you out Then when you're ready, look and apply online. You want to go through the pre-approval process first. Typically, an agent, the very first question that they're going to ask you when you call them is, are you pre-approved anywhere? And the reason for that is they work on commission only. They're not going to waste their time driving around looking for homes for someone who may or may not be able to be approved. They want to know that you can be approved. So they want to make sure that you have your pre-approval letter from a reputable institution. Once you've made that decision and you apply, what you want to be able to do is make sure that you have the documentation available to you that's necessary to get approved. So you're going to want your W-2s, your check stubs, bank statements. Any lender is going to check your finances and make sure that you have the ability to repay a loan and that you have the ability to make a down payment on a loan. So make sure that you have that information available to you. The good news is that technology has really taken a hold in the industry, and a lot of this stuff can be done electronically where you don't have to have a physical paycheck stub or your physical W-2. You can get some of that information online as you're applying. So, look for places like that allow you to use the technology to your advantage and lessen the load on the paperwork side. Also, discuss loan types with your loan officer. When you're assigned a loan officer, and you're talking with someone at the institution that you've applied with, make sure you're talking about what loan options are right for you. There's a lot of talk about the difference between a fixed rate and an adjustable rate loan. And a lot of people will ask the question, why would I ever want an adjustable rate loan? It depends. So if this is your first home, usually the longest anyone ever has a home loan is 7 years. So if you're buying your first home and you know that your plan is to get married, have kids, whatever the case may be, and you're buying a starter home, you know that you're going to be out of that home in a certain amount of time. If you're buying a home so in that case, you really want to take a look at an adjustable rate loan because you're only going to be in there a short period of time. You want to take advantage of the lower interest rate on those loans. If you're going to be there for a long period of time, if this is not your first home, or if you are already married, you already have kids, and this is just the next step in the evolution of your family, then taking the fixed rate loan may be the best rate for you, may be the right options. But talk to your loan officer about what is available to you and talk about how that may work for you specifically. And I believe we have a question, so I'm going to pause right here and take the question.
Yeah, so we have 2 questions. The first one is regarding to our rates on our website. So it's a little specific. You can go ahead and check it out and read it out loud here. It's already on the thread.
Okay, so according to our website, the 30-year fixed rate is at 3.25 and the APR is at 3.41. And the question then is, I know that credit scores determine the rate one gets for the mortgage. What type of credit qualifies for the specific listed rate? Very good question. The other question in there also is, what's the difference between the APR? So let's start with who gets the rate that's posted online. The rate that is posted online is effectively looking at an 80% loan to value. And if you look at the print on the bottom of the rates online, it'll tell you this as well. But it's for 80% loan to value, and it's for credit scores at 740 or above. Anything below the 740 mark or has a loan to value, which is basically how much your loan is versus the value of your house. It's exactly what it sounds like. If your loan to value is above 80% or you have less than 20% to put down, there are adjustments that are made, and they're made for the risk of the loan itself. Anything above 80% is considered to be a higher risk, and anything below a 740 is determined to be a higher risk. Let's say you're at a 700 and an 85% loan to value. Your rate might be 3.375 versus 3.25. So it's not going to be a significant amount above what you're seeing. Also, the other question was, what's the difference between the APR and the rate? The APR is effectively the rate minusing out the fees. So it's your interest divided by your loan amount, minusing out any fees that are within the loan. The closer your APR and your rate are together, the less fees that are on your loan. So you want to be as close to that rate that is being quoted to you as possible when you think about your APR. Ours obviously is very low. The only fees that we have are a $750 fee that comes to the credit union. Everything else is third-party fees that are associated, like appraisals, title work, things like that, that are inside the loan process. So those are, those fees are very limited from our perspective.
And then the other one is about credit scores with like Experian and FICO scores.
Okay.
And look at that real quick, and then we'll do the rest of the questions at the end.
Okay. I know you mentioned use of the middle score in regards to credit, but I have seen people talk about all kinds of mortgage scores based upon FICO scores. So what we see on apps like Experian.com isn't what you would use. Also, can we see our mortgage score? Okay. So yes, you're absolutely right. What I said earlier is what you see on Experian.com or Karma, Credit Karma, or anybody like that is not what we're going to see as far as the FICO scores go for mortgages. And that's because in reality, this is hard to hear, but there's over 1,000 different variations of a credit score out there. And it depends on what type of credit you're actually pulling. We can pull an Experian here locally for the mortgage side, and it might be one score, and we might pull the same Experian report the same day for the auto side. And because we're looking at two different things, it gives us two different scores. So unfortunately, that's the way the FICO system is set up today. It's got so many variations and weightings on it that it's very difficult to know. The other question was, can we get our mortgage score? The answer is after you apply for a loan, whether it's with us or anybody else, you are sent there are some documents that are sent to you that have your credit score on it. It also talks about what has affected your credit score. Those are required to be sent to you by law. So the second we pull your credit score, our credit institutions actually send that to you via the mail, and you get that within a couple of days of applying. We can also tell you what your credit score is right then and there when we're talking to you. So you can get your mortgage score. Nobody out there like a Credit Karma or anybody like that is giving a mortgage score. You do have to apply, unfortunately, to understand what the difference might be. All right. So, and also going back to where we were is on the home buying process. The next thing, after you talk about the type of loan, one of the first questions that a loan officer should ask you is, how much can you afford? How much are you comfortable with affording? Understand this: what you can be approved for is much greater than what you're actually comfortable paying for. And the reason for that is your availability of credit is based upon your gross income. None of us live on our gross income. Taxes come out of our income. We live on a net income basis. So even though you may qualify for, let's say, a $1,500 payment, if you're only comfortable paying $1,000, that's the payment you need to look at. So a good loan officer will ask you, how much are you comfortable paying? And then back into how much you should be approved for. You don't want to ask for the maximum because you may or may not be comfortable with that. And the last thing you want to do is become house poor by buying a house. You don't want to have to eat ramen noodles every night. You don't want to have to sit at home with no cable, no lights, no anything else because you weren't able to go anywhere or do anything other than make a house payment. You want to make sure it's comfortable. You want to make sure you can handle it. So make sure you're budgeting. Make sure you're looking at a good budget and that you understand what it means to you for the payment itself. We do offer budget here at the credit union, so you do have budget counseling through our Green Path Solutions team. So if you need some help with budgeting, contact the credit union. We're more than willing to help you with that. The next thing I want to be able to talk about is how we get into choosing an agent. And you see that here on these slides. I'm going to move to the next one here. The credit union actually has a company that we call Home Advantage. This is a program that we utilize here at the credit union. We actually have trusted agents that we work with that are a part of this agency. We actually have worked with those agents to be able to give a cash back award if you use these agents through our process. They give 20% of whatever their commission back is. Typical commission is about 3%. So 20% of that is about $600 per 100,000 that you purchase. So if you purchase a $100,000 house, you could get $600 back at the end of the process in the way of cash rewards by using one of our agents. We have 18 agents that we have available to us here in the local market, and we have all kinds of agents around the country. So if you're moving anywhere, if you're a part of the credit union, we can help you out. One of the things you want to make sure that you are looking at when you're thinking about getting an agent or hiring an agent, remember that they work for you. You're hiring them. Make sure you click with them. Make sure they understand what it is you're looking for. If you don't click with them, move on. Find an agent that you actually click with, somebody who understands you, who's listening to you, not trying to push you past your goals. Some agents may try to push further than what you need to be, sort of like some of the loan officers who may push you to your maximum available payment. You don't want to do that. You want to make sure that you're comfortable in what you're doing. Make sure that somebody is looking out for you and is keeping you in that comfort level. So make sure you're really finding the right agent for you. Once you've found that agent, start the process of actually searching for the home. What you may or may not realize, and you probably do at this point, 65% of the homes that are purchased today were found online first. They weren't found by an agent. They were found by the person buying them. And they called their agent and said, hey, can I get into this house? So get online, start looking for what's available. You're going to start seeing things that pique your interest. Look for those homes. Start that process there. Once you've found what you wanted, see it a couple of times if possible. I can tell you right now that may or may not be possible depending upon what the purchase value is that you're looking at today. Homes are moving very, very quickly, especially between the $150,000 to $250,000 range. They are moving very fast. They're getting multiple offers, and they're typically selling above their offer price. Anything outside of that, there's a little bit of flexibility. So you may or may not be able to see homes twice. But at least try to take pictures, try and remember. You're probably going to see multiple homes. You don't want to get confused. Also, make sure you're not looking at the cosmetics of the home. Paint color can be changed. Look at whether or not the home fits you and your lifestyle and what you want to do in your home. Look to make sure if you have kids that there's enough bedrooms for yourself, that you're not cramped inside the home, that there's enough play area, things like that. Or if you're growing a family, look for those same things. If you're a dog family, make sure you got your fenced in yard if that's what you want. Just make sure it fits you and what you're looking for, and make that list ahead of time. Make sure you're talking to your agent about that, and they can help you find those types of homes. So just remember, they work for you. The next process is once you actually find the home that you're looking for, you and your agent are going to work together to make an offer. During that process, there's going to be some negotiating. There's going to be some back and forth. Let your agent help you with that. That's not always the easiest thing to do, especially as buyers. We are very emotionally connected or emotionally attached to what we're doing. And the agent can act as that person who's acting unemotionally, who's looking at it from the business aspect and try to keep you out of trouble paying more for a home than what you should. So make sure you're relying on that agent for that. Once the negotiation phase is done and you have an accepted contract, you're going to go through the process of home inspections. You're going to start the appraisal process. You're going to go through a lot between the time that you actually get an accepted contract and we move towards closing. There's a lot that happens in there. Make sure you're dealing with a loan officer who's going to communicate with you, talk to you a lot, really keep you informed, and also make sure you're checking in. Make sure that they're doing what they're supposed to do. Don't just accept that they're going to be 10 days down the road before they contact you again. Check in and make sure things are going well. There's nothing wrong with that. calling in and making sure that the loan's moving the way that it needs to. There's no problems. That will save you a lot of headaches in the future. Also, make sure that you're checking in with your agent. Make sure that the contract's going the right way. Make sure the inspections, if you have items that need to be fixed on your inspection, make sure they're being done. There's a lot to be done there. Make sure you rely on your professionals to get you through. Also, what you may want to look at from the closing aspect is what are things like today, right? So one of the things we did want to talk about was the home buying process and how COVID has changed that process. So in looking at how has COVID affected the home loan process, you're seeing a lot more technology involved in the home loan process than you ever have, especially here in the state of Missouri. Up until April, we were not allowed to do e-closings. The state didn't allow for electronic signatures on notes and deeds until an emergency order was signed by the governor in April. Finally, the law passed in June, so now we have that capability here in the state of Missouri, but that was not even an option pre-COVID. Thinking about seeing a home, I just told you that 65% of the people find their homes online. There's a lot more virtual tours than there ever have been, and people are starting to look and not even go into the home. Some people are relying on their agent to go into the home and do a FaceTime call with them and actually have them walking around the house. It's all going to be based upon your comfort level and the seller's comfort level. If the seller doesn't want people in and out of their home, they're not going to let them in and out of their home. They may be worried about kids or other folks that live in the home that may be more susceptible to COVID. So ask those kinds of questions about the home that you want to see ahead of time. And if they could get you a virtual tour, that would be great. Trust me when I tell you, the technology today with the cameras and everything else, you can see cracks in the walls if they want you to see cracks in the walls. They're going to show you everything. So take the time to figure out what the best process is for you. Your agent should be able to walk through how virtual tours may work, when you might want to actually physically see the home versus a virtual tour, things like that. So use the technology, use what's in front of you to be able to walk through the process. So you also heard me talk about electronic closings now. It used to be that you would go into a title company and spend 45 minutes to an hour doing nothing but signing documents, and your hand would kill you at the end of the process because there was so many. That's pretty much gone now with COVID. The title companies don't want you in their buildings, so they want everything as much electronic as possible. They're doing curbside closings, which I would have never even thought of before COVID, but they're actually bringing documents out to your car. If you do have to wet sign them, they're doing that there. Our institution actually went to electronic documents where we could, so everything that can be signed without a notary is signed electronically via DocuSign, and then all your wet signing is your notary documents. So everybody is trying to move to a process that is more beneficial to the membership and to those who are a little bit more worried about how COVID may affect them. So I know there's probably a lot more to that. We don't have a lot of time to be able to talk only about COVID, but there's definitely an effect on how the home buying process works with COVID. The benefits, one of the things I want to do is talk about the benefits of working with the credit union. You see here, local loan officers, local processing. Everything we do here at the St. Louis office. We're here downtown, right off the river here, right outside of Soulard. All of our team is here, except for right now. Most of them are at home, working remotely today, but everybody is here locally. Everybody is hands-on. So there's a lot of benefit to that. If something's wrong with a file or we need something to move faster, we can literally walk to the next person and get that done. So a lot of benefit to that. A lot of brokers and other people are in different states. They have their underwriters in different places. Their processors are in a different place. And it just becomes a nightmare to try and get anything done. When you have that local feel, there's a lot more ability for us to help you directly. Plus, as members, your membership means something to us. Your relationship means something to us. So we're going to go that extra mile for you. Also, the other products that we have a lot of specialty products that are designed just for our membership. Things like the community contributor for our frontline folks, for those people who are in the healthcare community, your firemen, your policemen, all kinds of other frontline heroes that we rely on daily can get special loan products with special down payments. Also, your servicing is here locally. That's a huge one. If you don't know, a lot of people, especially brokers, they close a loan, they sell it to somebody else, and then you're dealing with somebody else for the next 30 years. When we close a loan, we deal with just ourselves for the next 30 years. Forgive us on the blackout. So we'll go to the PowerPoint presentation for just a second. I guess I didn't move enough, so the lights went out. So just understand that there's a lot of benefit to dealing with the localness of the credit union. And then next things, just utilize our resources. We have our website out here. We have the resources. You can tell by some of the questions that some of you have already been on the website and are looking at it. Use those calculators. Look at GreenPath. Look at Home Advantage and how it might help you. Take a look at all those resources and determine how they can work with you, and then work with your loan officer to help through some of those processes. You can see a lot of the things that I'm trying to go through real quickly are in this home buying process module that are out there. So think through how that might help you as well. So I know I'm a couple of minutes over time. I don't want to run too much. I want to respect your time. I could probably go on for another hour for most of the things that I have, but I'll shoot it back to everybody that's online and think about how we might do some questions here. So do we have some questions?
We got 3 more.
Okay.
Here's the first one.
All right. Okay. So on questions here. And of course, I went way higher. All right, so you mentioned additional mortgage fees. How much are the closing costs usually? I hear people talk about this additional cost, but I'm not always sure how much money to set aside. Great question, Kayla. Thank you very much. Typical fees for us are $750. That's our underwriting and processing fee. That's what keeps the lights on, even though they went off a minute ago. That's all we charge. Now, you're going to have title fees. You're going to have an appraisal that has to be done. That's an extra fee. You're typically going to run, depending upon the loan size, for an average $150,000 house, you're probably talking about $2,500 in fees total. That should include your escrow. So one of the things you also have to recognize is when you close a loan, there are taxes and insurance that are due throughout the year, and you have to put money into those accounts when you close. So you're going to have money put aside for that. That's part of the closing cost. So if you're looking at, let's say, a $4,500 or a $5,000 down payment, look to have at least another $3,000 to $3,500 to put along with that for your closing cost. All right, question number 2. All right. How long should I wait between financing and getting a pre-approval letter and purchasing a house? Will getting pre-approved letter ding my credit? Great question. So pre-approval letters are good for 4 months. And the reason why they're good for 4 months is because when we pull your credit file and your credit score is good for us for 4 months. So will it ding your credit? No, because you're going to go 4 months at least on that process. So you are able to making sure that I get the whole question, it will not ding, and the pre-approval letter. You'll get the pre-approval letter immediately upon your application, as long as you're able to be approved. You can start the buying process right then and there. If it takes you 2 months to find a house or 3 months to find a house, that's fine. We don't just discard your application. What we do have to do throughout that process is, if you aren't done within 4 months, we do have to redo your credit and give you a new pre-approval letter. So you're absolutely comfortable going out and starting that process immediately upon getting that pre-approval letter. And then we have one more question.
2 more.
2 more.
Actually, 3 more.
Okay, 3 more. Excellent. My partner does not have established credit. Not bad, not good. Okay. I have a credit score that is, most online show 756. What might occur if we choose to apply for a mortgage together? That is an awesome question, actually. There are things that are called non-traditional credit lines. Okay. So if your partner does not have credit and you do, we'll look at the non-traditional credit lines. We'll look at things like cell phone bills. We can establish, as long as we can establish that they have 3 lines of credit, we can actually still do the loan. We actually do it on a manual underwriting basis, so we don't base it on a credit score at all because your partner doesn't have one. So we'll have to look at, what the manual underwrite does for the actual credit score. Usually there's not a major effect on the credit score when we're doing manual underwriting in that case. One more here. Can I bid above what I am approved for if I need to go slightly higher than the house? The answer is yes. You can bid as much as you can actually be approved for. Like I said earlier, if you've told somebody that your comfort level is $1,000 on a payment, but you can be approved for $1,300, and you end up going a little bit higher on your bid that would make your payment $1,050, all you have to do is get the amount pre-approved by your lender. Most of the time, when you put in a contract, they're going to require that you have a pre-approval letter for the amount in which you are trying to put in the bid for. So what you'll want to do is, if you know that you're going to have to go a little bit above, get that pre-approval letter updated before you do that bid. All right. And what looks to be the last question, can I finance the closing cost? The answer is no. Not on a purchase. You cannot finance the closing cost. You do have to have that money out of pocket. There are things called gifts. So if your parents or another blood relative is offering to give you a gift for down payment or a gift for your closing cost, you can get a gift for those, but we cannot finance them in. The only time that you can finance them in is on a VA loan. They do allow us to actually go a little bit above, and that's to give veterans a little bit of a perk, effectively. So we do have VA loans, and if you are a veteran, there is some capability there. But for the most part, a traditional loan will not allow you to actually finance in your closing cost. All right. Any further questions? Nope. Awesome. Well, hey, I appreciate everybody's time today. Thank you very much for the great questions. Thank you for your time this evening. We look forward to being able to do this again for you soon. I appreciate it again. My name is Larry Jackson, and thank you for being here.